is Rod Smyth. He is the Chief Investment Strategist at Riverfront Investment Group. Rod's got 25 years of global investment experience and helps manage $1.8 billion under management. 2 weeks ago, though, he warned that a correction was coming, and it did with a vengeance. So, Rod, let's kick it off with you. Why did you know a correction was going, and did you think it was going to be this kind of a correction?
Well, I wish I could say that I knew. What I try to do in bull markets is watch for moments when sentiment gets excessively optimistic. And my favorite measure of that is the Ned Davis crowd sentiment poll. It has a wonderful record when it starts to get up really high that if anything bad comes along, you know, you're setting yourself up for at least a correction. And so what we advised folk was that it was probably time to take a little bit of money off, or at least wait for better prices before going in and buying.
Okay. I mean, Rod, it is funny. I mean, we're all trying to figure out what happened here. Is it interesting that we haven't kind of figured this out yet?
Yeah, I mean, I have to say, when I knew I was coming up here, which was yesterday evening, I thought, well, by the time I'm on television, you know, it will be known. And so I'm a little surprised. But here's the thing. Is
it surprising or is it a concern? Isn't it worrying that we still don't know why you saw the Dow drop 1,000 points for a few minutes yesterday?
Yes, but as an investor, I have a pretty high level of confidence that prices are going to find the right level given a little bit of time. So I'm less worried about that. If I was trading, I'd be very worried about it. As an investor, though, what's interesting to me is that even though we were down big at one point, and then it became apparent that it was some sort of a trading glitch, nevertheless, we didn't come all the way back. And the market is still down. That's really the point that I take away, is we're clearly in a correction.
That's, you know, Rod, let me ask you, lessons learned here in the last couple of days? A reminder that the market, does still go down?
I think there's maybe an insight here that hasn't been mentioned enough. When I get worried, I worry about a situation where people start to get afraid of the US dollar and afraid of the US Treasury market, because that's the scenario where the US becomes Greece. And that situation is much less likely if you think about it this week, because the troubles in Europe have once again made the US dollar a safe haven, and long-term treasuries, which I happen to think are a very overvalued asset. I don't know why anybody would want to lend the US government money at 3.5% for 10 years if they had to hold all 10 years. But the bottom line is rates have come back down and the dollar's been strong. So the one fear that I have has really been taken off the table. Now, we've got to work through this. The other thing that's going to happen here, I'm pretty sure, is that the ECB, which blinked last weekend, is going to be doing a lot more blinking. So the European Central Bank has always set policy for the strongest link. It's always set it for Germany. And it's always been problematic for the rest of Europe. Well, now they're going to have to set it for the weakest link. So think about what's going to happen to Germany. They're going to get a weaker euro. They're going to get better monetary policy than they need. Sooner or later, Germany's going to come back really strongly from this. So I think there's some really interesting subcurrents that are getting lost in the
there's definitely
we can't forget that the earnings picture is improving.
No, you absolutely can't forget it. And the reason that I think we're in a cyclical bull and remain in a cyclical bull is because earnings are going to keep going up. So how could I be wrong? What could go wrong? And to me, as I look at it, the one thing that could really go wrong is that Europe might end up going into some kind of really big depression, tremendous slowdown that would be enough to turn the whole earnings cycle down. I put a low probability on that because why? We've got a playbook that the Fed has now established for what you do when you have a banking crisis and
I assume they're hopefully sharing it with...
There isn't any doubt. These chaps talk to each other all the time, and we got, I think, an announcement today that they're doing their equivalent of TALF, it looks like it's starting. So my guess is, as I said, is that the end result of this is more stimulus from Europe. You're also going to get a little bit of a slowdown in peripheral European demand and a little bit of backtracking in risk and commodities. That's actually good for China and India and Brazil, the countries that were seeing too much growth.
Right.
So this has all the hallmarks to me of a temporary thing, but we have to watch levels. If the S&P really starts to break down below, you know, I'd say 1050 would be worrying. I'm actually expecting it can hold in this 1080, 1100 level.